how do people invest money around the world? So you can go to this website, Capgemini, and every year they have a world wealth report, and it's designed for high net worth investors, and they take a look at what do people with more than $1 million of investable assets do with their money all over the world. They do it by region, by country, and so you can even see what people in Canada are doing as well. But globally, this is what you can see. So the allocation to, and this is not housing. Housing is not included in these wealth statistics. So real estate investments increased to 16.8% from 14% of total investable assets, and most importantly, equities were only 31 to 30%. Most Canadians are investing 60 to 70% of their assets in equities, and 30 or 40% in bonds, and virtually nothing in income-producing assets or in income-producing real estate or alternative assets. So let's take a look at this. This is from a chart, and I redid the chart from a group called Saville. It measures global real estate wealth and other asset wealth as well. So if I took a look at, this is not including housing. This is just investable assets around the world. 20% of global assets are in multifamily residential, so basically apartment buildings. Commercial is 11%, farm, timber, other types of real estate 11%. Public stocks together for all stock markets in all countries in the world, 23%. Debt, fixed income, mortgages, bonds, GICs, 33%, and gold, 2%. All right. Real estate is 42% of investable assets around the world. Public equities are 23%. So why would you have 60 to 70% of your entire portfolio in such a small sliver of the global wealth? It doesn't really make any sense. So our approach is different. We have, for about the last 20 years, allocated roughly a quarter of our clients' capital to income-producing real estate and other types of real estate. 36% is our equity allocation, and that includes private equity, not just public. And 35% in fixed income, including bonds, mortgages, and private debt, with 5% in alternatives as well. And that's the model that we think works. We're going to take a look at a little bit later at the end about how that's done over the last 20 years. Some of the issues are a challenge. Private equity is something that probably most of you don't have in your portfolio, and there are issues with it for sure. You know, it's an illiquid asset class. It's hard to diversify. If you're investing directly with private equity managers, typically your minimum investment is anywhere from $500,000 to $3 million, and it's higher fees as well. And it's hard to do diligence on managers, unless you're willing to spend a lot of time. So this is a graph, though, of why you might want to be in this space by Northleaf. So Northleaf has been investing in private equity for over 50 years, mainly through other managers. This is their 5-year, 15-year return. So that's through bull and bear markets between private equity at 14% versus the Morgan Stanley Capital Index or publicly traded equities at 8.6%. And there's a lot of different data on this, but there's a pretty big gap. So if you can live with the issues of illiquidity, you can actually get a significantly decent increase in risk-adjusted returns. And then that brings us to the question that concerns us probably the most, which is where's the low-hanging fruit gone? So let's look at each investment category. This is fixed income, and what you're looking at are real interest rates. Normally, real 10-year bond rates should be between 2 and 2.5%. Basically, today, they're zero. Not sure if you're aware of this, but the 10-year bond rate in Canada, the Government of Canada bond rate is 1.67%. So just imagine you're buying 10-year bonds, you're earning 1.67%, you're paying 50% of the interest in tax, and then you're trying to still get a 4% real rate of return after inflation on your portfolio. That's sort of tough. The second thing is stock markets. This is a chart of this Cape-Shiller index. It's a good way of looking at the value in the stock market. Right now, the stocks are still very expensive. They've recovered a lot from the crash, mini crash last year, to the point now where they're more expensive than at any other time except before the dot-com bust. They're more expensive now than they were as a percentage of earnings than they were in 1929. And finally, on real estate, cap rates, or income rates on real estate have been falling for more than 30 years. And I don't know how much lower they can go, but they're not a bargain. So the challenge is you have to ask yourself, how are you going to basically build a portfolio when there's no easy asset class to automatically go into? So our view is this: we're not generally market timers. We may have a sense of what we think is going on in the marketplace, but we find that market timing tends to not work. So our strategies include using private debt mortgages and corporate lending on the fixed income side to get a better risk-adjusted return, to focus on asset allocation. So for starters, we're not at 60%. We want to be maybe between 30 and 35% in equities. Looking at value investing, dividend growth, and private equity. All of these are strategies. On the real estate side, it may be expensive to just go out and bid and buy a building and try to put it in a portfolio, but it can be very effective if you actually create that building or find a building that you can add value to. And David alluded to that in terms of that shopping center that we bought and are developing in BC. Another thing to think about are market cycles, because everything, in pretty well all markets, moves in cycles. Great book by Howard Marks, who really knows his stuff, and he's talking about you sort of can bet on the fact that realistically the economy will grow over time, but your returns will be fluctuating a great deal. Obviously, markets get expensive, pretty well the way they are now. There's a lower probability for above average future returns when you're starting from this point. And of course, when markets are less expensive, exactly the opposite is true.